Okay, so you got hold of him? Okay. All right, so let's open this calc file. क्या हुआ? हाँ, इनके यहाँ पे कुछ प्रॉब्लम है। ये लंच के बाद ना एक बार इनको भेज देना। All this stuff is getting recorded. Okay, so okay, guys, please let's be quiet because we are recording everything here. So. Okay, so all this stuff is in your notes, so you don't need to write anything. You have access to all of this material. Okay, so let's now try to understand decision problems. Okay, so does everyone now understand what a decision problem is? Okay, everywhere you need to take a decision is a decision problem, right? What should I do with my excess funds? That's also a decision problem. And then you can disaggregate that decision problem into multiple levels. First you decide that, okay, you're just going to put it, you're just going to keep it in your bank account, okay, in your savings account, or you decide you want to put it into some longer term investment. Okay, then what type of investment should you have? So we are focused, as managers, we are focused on decision problems. So you have this note in your folder, okay, you don't need to write any of this stuff down. Okay, let's just go through decision problems so that we can understand, we have a better context to have the valuation discussion. Okay, so whole discussion on valuation is actually ought to be logically connected to decision problems. Okay, so where do we, let's have this, since I've not really prepared for this kind of discussion at this stage, but we can go through this. Okay, so let's understand now, we're not going to worry about the decision problems that we're going to cover now. Actually are very common, as I've been saying, most of the stuff that we are covering is common to both management of investment funds, investment portfolios, okay, which is a major type of problem, but it is also a set of decision problems that is shared almost 100% by people who are managing corporate treasury, corporate balance sheets, risk on a corporate balance sheet, right? Like Air India has a problem. Air India might have loans in foreign currencies. They are worried about exchange rate appreciation. They might have floating interest rate loans. Therefore they have interest rate risk. They are also exposed, you don't see directly on the balance sheet, but they have exposure to jet fuel, because crude oil prices will affect jet fuel prices, which is around 50% of a balance sheet, 50% of a typical airline's operating expenses, so it's a big risk. So all these risks exist on corporate balance sheet as well, on a corporate, in a corporate treasury as well. And the problems that we are discussing are actually almost 100% identical in both cases. There are some small differences. Okay, some of the problems are identical, but they are automatically solved in one of the cases. Okay, in some of these problems. But okay, so now this problem is a little bit hard for you to understand this discussion before we go into the discussion on asset classes. So everything is interconnected. So I always have a problem of sequencing things. See, before getting into the discussion on valuation, I wanted to discuss the decision problems, because valuation is actually connected to one of the decision problems. The valuation in most of the finance textbooks, you see that valuation is something that just drops from the sky. That now we are going to discuss valuation. Did you have that feeling? That sometimes you see that the discussion on valuation, okay, we have valuation, but why do we need valuation? Okay, so this question is, so it's actually connected to a decision problem. So I wanted to bring in the decision problem. Now three of the first three decision problems, to understand the first three decision problems, you have to understand what asset classes, markets and instruments are. Okay, so let's go back a little bit, and then we go back to, we have to therefore go back to your short version of the markets module. Are you following my logic?
Yes, sir.
Okay, so we have to do this markets first, because we want to get you quickly to the asset classes, markets and instruments. So far everybody has understood that we have defined a market as a venue for exchanging two assets.
Yes.
So in any market we are looking at two assets, okay? Alright, and we have defined certain terms. We call them base asset and terms asset, okay? Just to quickly recap once again, what is base asset and terms asset? If you ever forget, you can just work it out with a simple example that you're familiar with. If you go to the market and you try to buy sugar, Okay, what are you buying? You'll be discussing, okay, what is the sugar price? It might be 20 rupees a kilo, it might be 40 rupees a kilo, or 70 rupees a kilo. Okay, but what is not changing is that 1 kilo of sugar. That part is not changing. What is changing is how many rupees you need to buy 1 kilo of sugar. Is that clear? So this is something for which you don't need, I mean, you can always recall this example. Okay, if you ever get confused, think of it in these terms and try to get your perspective back through this simple example. That if you go to the market and buy sugar, then that 1 kilo of sugar is not changing depending on what the unit is. Okay. So the point is, in this case, the base, and think of the base as something that does not change. Okay, so the base is something that does not change. We can have a look at some of these other prices as well. Just very quiet today because the US is off for the 4th of July holiday. Okay, so the base asset, think of the base as something that does not change. Does that make sense? A base is something that is fixed, so it does not change. So therefore, this kind of example, sugar is the base asset in the sugar market in India. Sugar is the base asset. And what is the terms asset? Okay, the terms asset is Indian rupees. We say the terms asset here is Indian rupees because 1 unit of sugar, in this case the unit happens to be kilo, but you should think of it as 1 unit of sugar because somewhere else, maybe in a wholesale market in Gazipur or somewhere, they might be trading it in terms of a quintal or something like that. So the price may be quoted in terms of a quintal, but the point is it's always 1 unit. Okay, here the unit is kilo and there the unit might be quintal. Okay, so you have the base asset, the 1 unit of the base asset that is being priced, that does not change, that is a base asset. Okay, therefore it's a base asset. And it's called, the other one is called the terms asset because 1 unit of sugar is being priced in terms of Indian rupees. Okay, you could have also chosen to price it in terms of Japanese yen or Canadian dollars, but obviously here nobody is going to accept Japanese yen and Canadian dollars. So if you're buying sugar in India, most of the time you'll be trading in the local currency. This is clear? So it's being priced in terms of the local currency, which is Indian rupee. That's why it's called the terms asset. Is this clear? If you're buying sugar, Yash is not convinced. You're clear? Okay. So why do we call it base asset and terms asset? Okay, you have to remember the terms, but then if you get confused as to which is which, you can remember it in this way, that the base doesn't change. Think of a simple local market example, and then the terms asset is because it's being priced in terms of the terms asset. 1 unit of the base asset is being priced in terms of the terms asset. Okay. If we have, if we don't have it here, okay. Okay, I should just write a brief example. I'll just write it here and then I'll expand on it later. Okay, base has the sense of being unchanging and terms is in terms of. Okay, so I'll expand this a little bit later after the class. So now everybody understands this? We have recapped this. Okay, so as Rajan was asking about the earlier part of the definition, that this exchange of 2 assets, it's going to apply across the board for all markets. Okay. All right. So what I'm doing, let me just give you a little bit of a background. That this terminology, strictly speaking, does not exist in the market for all assets, but we are extending it. Its terminology actually comes from the foreign exchange markets. Okay. So in the foreign exchange markets, we use this term like a base currency. Here, for instance, this is an example of the foreign exchange market, dollar yen. So in the foreign exchange markets, we have this expression, base currency or terms currency. The terms currency is sometimes also called a quote currency. So what I've done is I've treated a currency. So what I've said here is currency is a species of asset. Remember, contract, be very familiar with this kind of lingo, okay? You should be, as management students, should be very familiar with this kind of lingo. Remember, we used to say contract is a species of agreement. So which is the larger category? Agreement is the larger category, okay? So this is how we write it in English. We say contract is a species of agreement. If you want it to be more formal, it doesn't sound very good in terms of the language. You write it as contract is a species of the genus agreement. But in normal language, we don't write it like that because it doesn't sound nice. We just say contract is a species of agreement. So the smaller category comes first, and then we say. So similarly, I'm saying currency is a species of asset. Okay. So I've defined asset here, as you can see in your earlier part of the notes, that in economics and finance, in academic economics, they make a distinction between asset markets and goods markets. but I'm not going to make that distinction because I don't think it's very it's a very useful distinction in the context of the study of financial markets in the modern world. Okay, so we don't make this distinction. So everything is an asset. Okay, so currency is an asset, crude oil is an asset, shares of Tesla are an asset, bonds issued by IBM are an asset. Everything is an asset. Okay, debt securities are assets, equities are assets. Okay, in the classical finance definition, only debt and equity securities would be assets. Okay, and the others would be treated as goods. Okay, so but I'm not using that classification because I don't think it's the right way to approach the study of finance in the modern world. Okay, so I'm calling everything assets. Okay, currencies, commodities, equities, debt, everything. Okay, is everyone following so far? Okay. So, what did I say? Is base asset. So the reason I borrowed this from the currency markets and I've extended it to the entire universe of assets is because currency is a species of asset. Okay. So therefore, what the market terminology that we use in the currency markets, which is base currency and terms currency, we can just apply it across the board to all assets by using the more general term base asset and terms asset. Are you following my logic? Yes, everybody? Okay? Alright, okay. So, that's what we are doing. So, I've borrowed, if anybody asks you, you can say that it's been borrowed from the currency markets, where it's an established practice, okay, to call it base currency and terms currency, okay? Right. So, in every market, therefore, as an initial, so we will expand this list later on, but at this stage, in every market, you have to establish what is the base asset, and what is the terms asset, and what is the unit. Okay, when we are looking at a market, you should try to identify these aspects. All right, so let's look at some of the currency markets. So if we look at currency markets as a starting point, where we are from where we're borrowing this terminology, base asset, terms asset. So here we have the convention in the currency markets is that the base asset will always be shown first. Okay, in the notation, the base asset is always shown first. So if we go back to Tanya's question about dollar yen, who is going to answer that? Sukriti? Can you help her? What was Tanya's question about dollar yen? Remember, we were showing a dollar yen chart, and what was her question? We were showing, I think, a 4-hour chart. What was her question? Do you remember? Give her the mic. Yes. Quickly pass the mic. We have to move very quickly, like a 4x100 relay team. Yes. What was her question on dollar yen? Do you remember? Okay, so something of that sort. So what she was asking is, when I look at this dollar yen chart, I'm not able to figure out whether it's $1 equal at this point, let's say 108, whether $1 equals 108 yen or 1 yen equals $108. Okay, so based on this clue that I've given you, that the convention in the currency markets is that the base asset is always shown first. Now can you answer the Tanya's question?
Yes, sir.
What is it? One by one, everybody is talking. Okay, let's have Jen answer. Give her the. Yeah. Use the mic anyway, even though you're on the first bench. So what is it?
Sir, USD is the base currency and JPY is the.
Okay. So what is this? 1 yen equal to $108? What is this chart showing us? 1 yen is equal to $108?
Sir, the JPY is dependent on the change in the USD.
No, that's not the correct. That's not a correct statement. No, that's not a correct statement. What you just said. JPY is dependent on the change. So the question is very simple. In this market, when we are looking at this market, are we supposed to read this as there's something showing 108, 109 on the right axis, right hand axis? Okay, the y-axis. Okay. Now, so here this the right hand axis. So now, is this supposed to mean 1 yen is equal to $108 at this point, or is it $1 equal to 108 yen? That's a simple.
$1 is equal to 1.
Okay, fine. Okay, so yes, Metal, what is your question? 108? Yeah, okay, so that's what it is, right? So because we know that in the currency markets, the convention is that the base currency is shown first. Okay, so from here you can figure out that dollar is the base currency, and if dollar is the base currency, then this has to mean that $1 is never going to change. Okay, and what is changing here on the price axis is actually the number of yen required to buy $1. Is everyone clear about this so far? Okay. All right. So this is what we just want to have some practice here. So if we want to go here, look at another very important international market. Okay, so this is interesting because gold is actually the international market for gold. Here we price it in terms of 10 grams and stuff, but the international market for gold and the main market for gold is actually the global spot market for gold. Okay, it's a OTC spot market, and this is, as you can see here, if we look at, I haven't looked at this chart for a long time. So this gold market, this is the main international market for gold. Although India is one of the biggest consumers of gold, okay, because we don't have free capital markets, we don't have free capital flows, etc. Okay, the international gold market is not. Ideally, India should be a big player. I mean, it should be. There should be a big trading center in Bombay, etc. But that doesn't happen because we don't have free capital markets. We have a lot of capital controls. We don't have a freely convertible currency. So therefore, the big markets are all in the international markets where everything is free. So this is a market that trades 24/5 all the way from Wellington to New York every day. Okay, so here you see the international. Now this price is quoted in terms of dollars per troy ounce. Okay, troy ounce is not the same ounce as you see in baking cakes. If you see cake baking recipes, there's ounce of flour and all that. This troy ounce is actually not the same as that ounce. It's a slightly different measure. If you want, you can just Google it. It's not important. We don't need to remember these things, like how many troy ounces is equal to 1 ounce and all that. This you can always Google later on. Okay, but the main thing is you should understand that troy ounce is a different measure from ounce. Okay, and you notice this about markets, that every market has a different unit. Okay, by convention. This is just a matter of convention. Okay. So this is the international gold market. So here, what is the base asset in this market? Gold is the base asset in this market. And what is the terms asset? US dollars. Okay, so you should always say dollars. You should always say US dollars because there could be other Canadian dollars. Okay, other Australian dollar, New Zealand dollar. So you have to always say US dollars. Okay, when you mean US dollars. Okay. So yeah. Use the mic. 1 minute. Yeah, go ahead. We are now just practicing our understanding of base asset and terms asset by moving through different classes of markets. Yes.
So why is it not written gold/USD?
Yeah, so this is a good question. So this is just a quoting convention. Okay, so it's only in the currency markets that you see that you have a clear guide which shows you that we have both the currencies shown and the base currency shown first. Okay, in the other markets the quoting convention is such that we don't write it as gold/USD. Although if you could also write it as gold. The symbol for gold is you remember the periodic table symbol for gold? AU, right? So it is shown as XAU/USD in certain quote machines. Okay, so the quoting convention. But in general, you will not have for the non-currency markets. For the non-currency markets, you will not have a clear statement about the terms currency. So you have to figure that out. That's just basically contextual knowledge. Okay, so you see in your notes on base asset and terms asset, you will see that maybe I have not put that here. Yeah, it's here actually. So this should. So the terms currency, remember that our definition of a market is a venue for exchanging two assets. So there have to be always two assets in a market. Okay, so it's just that in the non-currency markets, the quoting convention is such that we don't mention the terms currency. But that doesn't mean that the terms currency doesn't exist. Okay, it's always there. Okay, so because in any market you're going to be exchanging two assets, so two assets have to exist. But if the quoting convention is such that they don't mention the terms currency in the other markets, the non-currency markets. Okay, is everyone clear? The terms currency always exists. You have to be able to figure it out. Okay, so now typically what will happen? So we can discuss briefly about the terms currency in cases where you don't know what's like. This is a global OTC market, the gold market. It's not really confined to any particular location. So you have banks in Wellington dealing with banks in Hong Kong, who are dealing with banks in Zurich, who are dealing with people in London. The major center for gold trading internationally is for the spot gold market, the OTC market is London. Okay, so you'll see there's a London. I've given you links to the London Bullion Market Association. So London is a major bullion trading center. So when we say bullion, we include gold, silver, platinum, palladium. Okay, so you have massive stockpiles of gold in London. Okay, physical gold which is there in storehouses in London. So this is where but every time they trade, they don't necessarily move all the physical. They just move the certificates. Like it's just your title to the gold ships. Okay, kind of like in Calcutta when they used to have jute trading. It's a lot of the jute. Actually, the jute didn't move, but they would just give receipts and say that okay, now Hardik was the owner of that jute. Now that jute is now owned by Shreya because of a transaction. But the jute actually doesn't move. Okay, so anyway, so London is the major major trading center for bullion. Okay, so this is your so what else was I going to say here? Yeah, okay. So what you have as a general, so the terms currency we know always exists. Okay, so what is a rule for you guys to figure out what is the terms currency? Okay, like suppose I've shown you something like this, say Japan 225, which is a Japanese equity index. Okay, if we see, let me see if we have any other yeah, so if we have something like this, or if I have even so if I have, let's say, a stock price. Okay, so if you know where that stock is listed, okay, the general rule for you, because again in a stock price typically what will happen is they will not list the terms currency. They will not show the terms asset. They will only show the price of the stock. Okay, so if you see the price of any stock here, let's see what is coming up here. If we have so you have the price of Microsoft's common stock, which is coming up. Okay, so we know that the price is what, so it will be shown like this. So the display is going to be, the quote display is going to be MSFT is 137.46. Okay, so in this case, what is the base asset? So the common shares of Microsoft. Okay, the equity shares in India we would call it Indian equity shares. In the US they would call it common stock of Microsoft. So the base asset is the common stock of Microsoft. Okay, the pricing unit is 1. Okay, although this is a question that Radhika was asking yesterday, that because I said that in India the market lot is 1 share. Okay, but in the US the market lot is 100 shares. Okay, but the price quotation is still on the basis of per share. Okay, so if you go to trade in Microsoft, you see that the price is 137.46. Okay, but when you buy one lot of Microsoft shares, you still have to pay 137.46 into 100. Okay, so the price is quoted on a per share basis, but the market lot is different. So there are two different concepts. The price quotation convention and the market lot convention are two different things. So you should not confuse them. You should actually query those two things separately. Is that clear? Okay, so you should be aware of so these are matters of convention. So these are not conceptual issues. This is like you come to India, if you're coming from the US, you come to India and you find out, okay, here these guys drive on the left. Okay, so this is just something, so it's not a major conceptual issue, it's just information. It's just like, it's just information. Okay, so in this case, if you are told that MSFT, the base asset is the common stock of Microsoft, what is the terms asset? US dollars. Okay, it's US dollars because it's listed on the, you can see this is a NASDAQ listed stock. Okay, the NASDAQ is a US based exchange, so it is, in this case it's US dollars. Okay, so this is a safe strategy in general. There's an exception to this. So the general safe strategy is you have to know where you are trading this particular base asset, and so general rule is that it will be the local currency of that location. Okay, but there are some exceptions to this, which is, for instance, so is this part clear? The general rule is clear to everyone? Even so, the terms currency always exists, even when it is not being shown in the quoting in the quote display. Okay, it will always exist.
You mentioned the actual currency in US dollars.
Yeah, in this case it's mentioned, but it may not be mentioned. Okay, good. So you're observant. But in this case it's mentioned, but it's not. It need not be mentioned. So even if it's not mentioned, you can use this rule to figure it out. Figure out where this thing is being traded. And as a general rule, it will be the local currency of that location. Okay. But there are some exceptions. So the general rule is clear to everybody. The exception is this. Okay. So I've given you all this stuff here. So basically you don't have to write anything. Your job is only to pay attention in the class and understand that you have not understood something and immediately raise your hand and ask a question. Okay, so the exceptions to this rule are, so I've given you the link to if you want to learn about the international bullion market, physical trading in paper trading and physical trading as well. I've given you the links to the LBMA, which is the London Bullion Market Association. Okay, so now there are certain internationally traded markets, right, which is like gold and all, etc., are internationally traded markets. So as I showed you this particular chart, this price of gold, this is the international market for gold. Now when gold is being traded in London, okay, normally you would expect that the terms asset should be British pounds because it's being traded in London, okay, but the general rule does not apply in the cases of internationally actively traded global markets where they're all traded against US dollars. Okay, so gold, so this is a little bit odd because gold trading in London is actually going to be traded in terms of US dollars to maintain the international convention. Is that clear to everyone? So there are many such markets like copper, gold, silver, platinum, palladium, all these markets. These are all internationally traded markets. So these are all traded in terms of, even when you're trading oil, there's a fair bit of physical oil trading also going on in London. So that also is happening in terms of US dollars. Because these are all global markets, and because the US dollar is the most dominant currency in the world, okay, and it will once again, let me remind you to study the US economy. You hear a lot of garbage about how the Chinese yuan is going to replace the US dollar. That is total garbage, okay? It's not going to happen because the Chinese economy has even tighter capital controls than India. The US doesn't have capital controls, okay? So that's why it's the most liquid financial capital market. All the people who have excess reserves, all the central banks who have excess reserves, even the Reserve Bank of India managing India's excess reserves, where do we put them? A big chunk of it we put in gold, a big chunk we also put in US Treasury securities. Everybody goes into US Treasury securities because that is the most liquid, safe asset in the world, okay? It's sovereign debt of the US. So this notion that you hear that, you know, other currencies are going to replace the US dollar, like the Russians and all are setting up a separate, this is a total joke, okay? Then nobody comes even close to having their kind of liquid capital markets. No other country even comes, even the Europeans don't come close. It's a massive market, very deep and liquid market because of the size of the economy as well, and because of the policies they follow. So the US dollar will remain the dominant currency even for your lifetime, okay? So therefore these international markets are all traded in US dollar terms. Okay, so you'll have, when you trade gold in Hong Kong, you'll be trading in US dollars. Okay, when you trade gold in Zurich, you're trading in US dollars. Okay, everywhere. Okay, so this is the point. Okay, so are we learning some things now?
Yes.
You are able to understand, you're learning technical points. Make sure you revise all these things and internalize everything. Okay, it's not very complicated stuff, but it's all new stuff. Okay, and some of it is not completely intuitive, okay, and obvious. So because you're learning new stuff, you have to revise it once or twice and make sure you finally understood it, and then you can just file it away forever and you'll never forget it, hopefully, okay? But if you don't do that initial revision, it will not stay in your head, okay? So what we are learning is that the terms currency always exists, okay, which is the question that Chug has led us to with his question. Okay, so we go back to this part. We borrow this from the base. Okay, the second point we want to learn is okay, we try to cover this. Okay, this is still 3 o'clock. Okay, all right. So let's try and understand. This is again not a very complicated matter. Okay, let's try and understand this. Okay, so far you understand market is a venue for exchanging two assets, the base asset and the terms asset. Okay, quoting conventions, we have learned a little bit about quoting conventions. So the the concept that we want to have is that every transaction in a market is a contract to exchange assets. Okay, just like I have a contract with the furniture seller that I will pay you, 1 lakh rupees. You design the furniture for my living room. You make the furniture for my living room and deliver it. That's a contract. Okay, it's a service plus product contract. So similarly, a transaction in a financial market, we will see it as we are already familiar with what a contract is. Okay, so it's a contract to exchange assets. Because what's happening in a financial market, there are two assets that are being exchanged. Okay, so whenever we have a contract in a financial market, we are going to see it as whenever we have a transaction in a financial market, we are going to see it as a contract to exchange assets. Does that make sense? It fits into what you know so far, because in a financial market, what do? We exchange assets. So when we do a transaction in a financial market, we are going to do, instead of seeing it directly as exchanging assets, we will see it as a contract to exchange assets. Okay? So the moment you enter into the contract, you are obligated to perform the contract. Okay, so we will see now slowly. And so the other thing to understand is, obviously, because it's an exchange of assets, so the other thing that should be straight away drilled into your brain is, whenever you're selling something, you're buying the other. So here, if I sell gold, what am I buying? US dollars. So now you have to think of, so it's a little bit again counterintuitive, because we usually only think that, okay, I've sold gold. But now, because I've told you that a market is a venue for exchanging assets, there are always two assets. So obviously, and if there is a concept of exchange, means one goes out and the other comes in. So if you are selling something, you have to be buying something. Okay, just like it's like if I go to the coffee shop and I buy coffee and I sell Indian rupees. Yes. Okay, you have to think. So it's a little bit odd to look at it this way, but this is the right way to look at it, because it will help you to understand the flow in every transaction. Okay, now you have to see it as it's an exchange. So whatever, if you are buying here, then you should be selling the other one. Okay, so we say that, okay, so whatever you're doing to one asset, the other asset you're doing the opposite action. Okay, so I'm selling gold and buying US dollars. This is clear? Okay, and now if I, let's say, take oil, and if I'm buying oil, then I think the answer will come faster than, the chart. So if I'm buying oil, then what am I selling? US dollars. Okay, I'm buying oil and selling US dollars. Is everyone clear? Yes. Every market, that's why I said every market you have to figure out what is the base asset, what is the terms asset, and what is the unit of trade. Okay, that basic information you should, whenever you see a market, you should try to identify these few things. Okay, so and so the idea here is that because it's a contract, every transaction is a contract to exchange assets. So when you buy one, you sell the other. Is this clear? Or sell one, you buy the other. Okay, this we have already discussed. Okay. What else is here? Display convention I've already discussed with you guys. Okay, so this you also have to be clear. Okay, so this is again a matter of contextual. This you'll figure out eventually. Okay, so these things, the other thing that you should know about, these terms that we use, okay, INR, SGD, JPY, these are known as SWIFT codes. Okay, or sometimes also called currency codes. SWIFT stands for the Society for Worldwide Interbank Financial Transactions. Okay, so you should be able to remember. You can just Google it later on. Okay, SWIFT is an agency which handles all these international payments. Okay, so it's a payments network. Okay, so kind of like if you think about in India, we have the NEFT RTGS payment network, which connects RBI connects RBI to all the other commercial banks. Yeah. Mike is right in front of you. Yeah.
So we are having the display convention.
No, display convention I've done. Where do you see display convention? Yeah. We've done this, no? I told you that in FX price quotations, the base asset is always shown first. So we have done display convention, right? Yes? Everyone is following? Gulati? Yes. You're following on your mobile phone? Okay. Alright, so here, hence JPY is the terms as we already discussed. Okay. So far, okay, so this is again just a matter of conventional knowledge. These are called SWIFT codes, this you should know. Okay, so if somebody asks you what is the SWIFT code for Swiss franc, maybe I've written it here. or maybe somewhere else. I didn't put it in. CHF. Okay. So why is it CHF? Like somebody might say, why is it not SWF? Okay. So CHF is because if you notice Swiss consulate cars in Delhi, they will have CH. Okay, CH is the name for official name of Switzerland. It's Confederation Helvetica. That's the name for Switzerland. That's why it's Confederation Helvetica Franc, CHF. Okay, not a big deal. It's just like a quiz, trivia, and question. Okay. So Swift codes, these are called Swift codes. So generally, the rule is that most of the currencies are quoted against the US dollar. Okay, in most currencies, the US dollar is the base currency, but there are some exceptions. Okay, like any exception that you know where major currency pair where US dollar is not the base currency. Can you see here? Euro is a major currency pair. Euro dollar FX is a major currency pair where euro is the base currency, not US dollars. Then sterling, cable. This is called cable. Actually, this is already written in your notes. The name is cable, like in cable television. Okay. So sterling US dollar is referred to, that exchange rate is referred to as cable. Okay, because in the old days when the British when Britain was a very big major global power, the exchange rate used to be sent, the closing exchange rate in London used to be sent by undersea cable to New York. So that's why this sterling dollar exchange rate came to be known as cable. Okay. So anyway, so these are some cases where Aussie is another case where US dollar, this is the quoting convention. Okay, so if you see Aussie here, okay, so this means, Puneet, this means 1 US dollar is equal to 70 Aussie cents, is that correct? Yes? Vittal, you agree with your friend? 1 US dollar is equal to 70 Australian cents?
So it's 0.7 dollar US dollar is equal to by 1
Aussie dollar. Okay, so he's correct. Okay, because remember, what did we say? Base currency convention is base currency shown first. Okay, so therefore it shows you, that means this is 1 Aussie by 70 US cents. Okay, so this is, so you have to remember this. So when all this stuff you have to revise and internalize it, so that now it just comes like that. Okay, so make sure you revise it until you can do it very easily. All right, so there are some exceptions. This is just a matter of convention. Okay, but you need to know, so when you're training as a finance student, it covers both types of knowledge. This is contextual knowledge, just knowing that Australian dollar is quoted in this manner. Okay, Aussie dollar US dollar exchange rate is quoted according to this convention, and that dollar yen is quoted into according to with the US dollar. These are all elements of contextual knowledge. Okay, there is no concept involved in this. This is just like information. Okay, but you need to have both. You need to have the information, and you also need to have conceptual clarity. This is clear? Okay. All right. So we are covering all this. We've covered all these terms. Asset always exists. Okay. Exceptions to this rule. Okay. So remember that we said that every transaction in a financial market is a contract to exchange assets. Remember this, okay? A market is a venue for exchanging assets. You have base asset and terms asset. There are some conventions in every market which determine what is the base asset, what is not, okay? So, but then we said also that therefore transactions in a market, in the financial market, are contracts to exchange assets, okay? It's a contractual obligation. You enter into a contractual obligation to sell something and to buy something else, okay? Now, what we say is therefore, we also want to understand something else, which is transaction dates versus settlement dates. Very important concept, very simple concept, nothing. It's just that suppose I go to, again I'll give you the example of the furniture shop, okay? If I go to my local furniture seller and I agree the terms and I say that okay, these pieces of furniture in my living room, you're going to make these and deliver it to my house, okay, and I will pay you this amount of money. So, and maybe I pay a deposit or whatever, but let's just take a simple example where he trusts me and we enter into a contract to engage in this kind of exchange, that I will pay him a fixed amount of money and he will deliver certain pieces of furniture to my living room, okay? and this delivery is going to happen, let's say 1 month from now. Okay, so today, which is T0, okay, so today is our the transaction date, okay, where we have entered into. So my obligation, so after 1 month when he delivers the material, I can no longer say no, I've changed my mind, okay, because I'm already contractually bound from T0. The day I've given him the order to make this stuff and deliver it to my house, I'm already contractually bound, okay, but nothing is being exchanged on that T0. And let's say we have cash on delivery arrangement, okay, we have a cash on delivery arrangement, so that I tell him that you deliver the stuff, then I will pay you the cash, okay. Just to make it simple, I'm just constructing this example. So the transaction date is T0 when I give the order to him and he agrees that okay, for this amount of money he is willing to deliver these pieces of furniture, okay, is that clear? So that's the transaction date is T0. And 1 month later, when he actually delivers the pieces of furniture and I pay him the cash, that is what is called the settlement date. Okay, a settlement date is the date on which the assets are actually exchanged. Okay, so we also call it, sometimes we also call it a value date. All this stuff is written in your notes. Okay, so essentially there's no need to worry about this at this stage. Okay, and every transaction will lead at least eventually to an exchange of assets. Okay, because it's a contract. Every transaction is a contract to exchange assets. Okay, this part, italics part, you forget about. It's just meant to cover the case of options. Is this clear? Read this. So everyone understands now we are defining two concepts: transaction dates and settlement dates. Remember that your contractual obligation is already crystallized on the transaction date. You cannot wake up on the settlement date, even if it's 6 months later, and say, oh, I'm sorry, I've changed my mind. You are already contractually bound from the transaction date. Is that clear? So remember, here you can recall all your contract law terms: consensus, addendum, and all these things. Meeting of the minds. You agree on all the terms. Okay. All right. Okay. So the exchange occurs on the settlement date, sometimes also called delivery date or value date. Okay. So if you see here, I've just made a. We want to study everything from a multidisciplinary perspective. So we can quickly flip here to the Sale of Goods Act in India. Okay, if you look at section 5.1, it actually takes care of this kind of a situation. See what 5.1 says. Just read this italics part. So once again, you can revise your contract law terms. There is an offer. If you remember at the very beginning of the contracts module, we discussed this section, which is because this concept of offer and acceptance is not actually there explicitly in the Indian Contract Act. Okay, they discuss it in parts, but just to say that a contract is made by an offer and an acceptance, that part is not there. But you see it in the Sale of Goods Act. There is an offer, there is an acceptance. Okay, so you can see that the contract. So the contract becomes crystallized when you do this offer acceptance, but the delivery can be either immediate, okay? It can be either immediate. We can highlight this a little bit. We can have either this, or we can have installments, or we can have postponement. Okay. So if you take the extreme case of postponement, this also brings out the idea that the transaction date and the settlement date are two different concepts. Okay, that you enter into a contract, but the exchange of assets, which is the subject matter of the contract, that actual physical exchange may happen at a later date. It may also happen on the same date. Even if it happens on the same date, we say that the transaction date and the settlement date are the same. We don't say that there is no settlement date. Are you following? Yes, sir. So if the transaction date and the settlement date, if the exchange of assets happens on the same day, if it's immediate exchange, okay, following the contract, then we say that the transaction date and the settlement date are the same. Are you following? See, we have defined transaction date as the date on which you enter into the contract.
Yes.
And what is the contract? It's a financial market contract, so it's a contract to exchange assets. Okay, that defines the day on which you enter into the contract to exchange assets is your transaction date. Then you have a settlement date, which is the date on which the actual exchange of assets will take place. Now, as you can see, even in the Sale of Goods Act, it is possible that the exchange of assets will be immediate following the conclusion of the contract, which means that the transaction date, which means that the actual exchange of assets can happen on the same day as the day on which you finalize the contract. Alright? But even in such a case, we say that the transaction date and the settlement date happen to be the same. We don't say that there is no settlement date. Are you following?
Yes.
So this discrete definition of a settlement date as the day on which the exchange of assets has to happen, does happen, is always going to be present. Is that clear? Everyone's following? Okay. So we have defined two new concepts, transaction date and settlement date, and that follows from the earlier definition of a transaction in a financial market as a contract to exchange assets. And that is again connected to our earlier definition of a market as a venue for exchanging assets. Are you seeing how everything is connected? Yeah, you're following? That's why you need to understand the basics, so that make sure that at each step you've understood what is being discussed. Because then if you don't discuss that, the later stages will create problems. Okay, so market is a venue for exchanging assets. We call them base asset and terms asset. Okay, various conventions. What is the base asset? Then a transaction in a financial market is a contract to exchange assets. Okay, then we define two dates. Transaction date is the date on which you finalize the contract, because remember, some contracts can be some settlement dates can be as far as 5 years, 10 years, 20 years forward. You can have 20-year forward foreign exchange contracts, okay, which means you enter into the contract today at T0. The contract refers to an exchange of currencies which will happen 20 years later, whatever you want to call it, T1 or whatever, but it's a settlement date. So the settlement date can be 20 years later. Okay, so you have many long dated, it's not the majority of the transactions are not so long dated, but you have many long dated transactions like this. Okay, so you can have very far away settlement dates which are very far away from the transaction date, and you can also have them collapse together into one, which is the same day. Transaction date and settlement date are falling on the same day. Okay, but we still think of them as two separate dates. Transaction date, settlement date just happen to fall on the same day. Is that clear? When the exchange is happening immediately, as shown here in this section 5.1. Okay, so are you following? Now we are ready to jump to this framework. Okay, here this is already there in your notes. So has everyone followed so far? Okay, so therefore we'll now jump to this framework, which is which we'll keep referring to. Maybe we should make it a little smaller. Okay, now you can see everything. It's actually, you should have made it a little bit bigger, the whole picture. But anyway, everyone can see? Okay, so this is a framework where you can see, just try to understand. Obviously there are some limitations. I wanted to do an Excel, do it in a spreadsheet, so there are certain drawing limitations. If I did it freehand, it would be much better. But you should be able to figure out how to read this. So you can see now Google Sheets allows you to turn around the arrows and all that. You can actually tilt it around 45 degrees and all that. So these arrows, now I put this arrow down here. So these are the asset classes. Okay, we'll figure out later what these terms mean, but first try to understand how to visually read this framework. Okay, so this is basically a matrix kind of structure. Okay, so you have asset classes going down in the rows. Okay, these are the major asset classes. So we've defined 5 major asset classes. Okay, everyone can see that. It's a little dark, but you can still read. Anjum, can you read? You can't read. So are you making a general statement that you can't read, or you're referring to this? You can't read real estate here. Why? It's too dark. It's too dark or the font is too small? Font is small. Oh, light is creating a problem. Okay. So just switch off the light here and see if you can read. But then there's a problem that if you switch off the light, I won't be able to see my. Okay. So let's at least make sure that. Now can you read it? Okay. No, switch it back on. I need to see my keyboard. I'll call out. I need to see my keyboard. Okay. All right, guys. 1 sec. No. Just keep one. No, not that. You can switch out. I need this key. I need this light. Yeah, okay. Yeah, all right. Okay, guys, I'll call out. Don't worry, I'll call out. Okay, so you see real estate, you see 5 major asset classes. Okay, we'll discuss all this stuff later. What is an asset class and all that. Okay, then I've defined another category called instrument. Okay, so these are all types of instruments. Okay, again, you'll find out later what is exactly what is an option, what is a forward. At this point, don't worry about the fact that you don't know what a swap is or what a forward is. At this point, you should just understand that, okay, what I mean by this framework is cash, spot, futures, forwards, swaps, options are instruments, and currencies, commodities, debt, equities, and real estate are asset classes. Okay, so these are just terms. And then how do you read this? So here what I'm trying to show, again, we have another type of definition, OTC markets versus exchange traded markets. If you see the long version of your notes on economies and markets, you'll see this distinction. Okay, so what I'm trying to show you here is that cash and spot markets, okay, cash markets are always OTC markets. Please pay attention, guys. Make sure you understand how to read this framework because we'll have to keep referring to it. And yes, what happened? There's some problem. Mike, I can't hear you. Okay, full form of OTC is over-the-counter markets. Okay, so that's all there in your notes. Okay, you can read it. OTC, full form of OTC is over-the-counter. Even when you go to a pharmacy, you sometimes buy OTC drugs, like all this, these painkiller drugs that you have, typical paracetamol type of drugs. Okay, these are all called OTC drugs because you can buy them over the counter without a prescription. Okay, so these are called OTC drugs. So the same meaning of OTC here, the same expansion, and ET is exchange traded. ET means exchange traded markets. Okay, so what am I trying to show you here? What I'm trying to show you is cash markets are only OTC markets, and spot markets can be OTC or they can be exchange traded. So try to read, I'm just trying to explain what I'm trying to show you through this framework, how you should read this because it has certain limitations. Also what I'm showing you is futures are only exchange traded markets. This is what this means. Is everyone able to follow what I'm showing here? And I mean what I intend to show through this kind of a frame, through the way that I've arranged it. Okay. What I mean by putting ET markets over here is that I'm trying to show that futures are only exchange traded markets, that forwards are only OTC markets. Okay, so some of this knowledge you can derive on your own from just by looking at the framework if you know how to read it. Okay, so what I'm showing you here also is that options have non-linear payoffs. Only options have non-linear payoffs and all the other instruments have linear payoffs. Now what is a linear payoff? That you don't know, but at least now you know that this much. This is like a first level knowledge. First we have to identify all the categories and then we'll define them later. Okay, so you know that these instruments have linear payoffs all the way from cash to swaps, and only options have non-linear payoffs. And then you know that this futures, forwards, swaps and options, these are derivative markets, okay, or sometimes derivatives markets, and these are called cash and spot are underlying markets. Okay, there are some exceptions where futures can also be underlying markets and options can also be underlying markets, but we'll get to those later. But in general, this is the setup. Okay, that cash and spot markets are underlying markets and these are derivative markets. So these two terms are used together. Derivative markets will always refer to some underlying market. Okay, so now everybody understand how to read this framework. Okay, and what we are going to do is like what I was showing you just now. Remember I was showing you the gold market. Okay, so when you see what is the objective of this kind of a framework, the objective is because there's so many markets in the world, okay, and so many different types of instruments, you get very confused, okay, if when you encounter these. So this is meant to help you get some sense of perspective by having a framework into which you can put different markets and instruments into certain boxes, okay, and that's how it'll help you to make sense of the whole markets landscape, because the landscape is quite vast, okay. When you look at the landscape of markets, it's quite vast, okay. So for instance, when you look at the gold market, here, as I told you, this is an OTC spot gold market, okay, the international market for gold. Where would you put this? Here in the framework. Is gold a currency? It's a commodity, right? It's not equity, it's not debt, it's not real estate. Gold is a commodity, okay? So gold is a commodity, and as I told you, this is the OTC spot market for gold. So this goes here, okay? So there is also a fairly developing market in coal. Coal also you can put here. Coal is a commodity, and there is a spot market for coal. So that's a commodity that goes into this box, okay? So it's at the crossing of commodities and spot. Are you able to follow what's going on here in this framework? Okay. So here, for instance, you can see here already what I mean by why is this framework called asset classes, markets, and instruments. Okay, because asset classes and instruments you already understand. What I mean, you don't understand what the instruments are, but you know what I'm referring to as instruments, right? Okay. So this framework is called asset classes, markets, and instruments. Why? You can't see markets anywhere. You see only asset classes and instruments. Okay. But here are the markets. Okay. So in this box, I can also put steel. Okay. If I just put steel for the sake of argument. Now there's a spot market in steel also, okay? Now, so here you understand what is meant by why this framework is called asset classes, markets, and instrument, okay? So spot is a type of instrument. It's like a type of contract, okay? So here, and this is not an exhaustive list, okay? This is obviously, I'm limited by space. I want to make sure that people can read the stuff, so I can't. So you can imagine this little box in which where my cursor is. You can imagine that you really blow it up and make it a huge box where I can write down all the global spot market, all the spot markets and commodities, okay, like copper, everything else, okay, here oil, copper, everything else, all the commodities, spot markets you can think of. Imagine that this cursor, where this is cell number D13, cell number D13 is blown up and made into a huge cell in which I can type in all the spot commodity markets, oil, copper, zinc, aluminium, everything I can think of, okay?
So, agro-commodities.
Yeah? Yeah, all agro commodities, wheat, wheat, rice, okay? Corn, okay? All those things, okay? Everything you can think of. So try to understand how this framework is to be mentally used. How this can be useful to you. So what do I mean by the markets part of the framework? Asset classes and instruments, you know what I'm referring to as asset classes and instruments. Now where do the markets come in? This is where the markets come in. At the intersection of the asset class and the instrument. At the intersection of those are the markets. So imagine here, for the sake of, because there's not enough space here, I can only write 3 markets, gold, coal, and steel. But imagine that this cell was massive and I could write all the spot commodity markets in the world, like she said, wheat, rice, everything, okay, corn, soybeans, okay, soybean has split into, you have 3 markets. You have soybeans, you crush the soybeans and you can make it into soybean meal and soybean oil. So you have separate commodity markets for those also. You have 3 markets actually in soybeans, okay. So all of those markets, imagine that this is a massive cell and I can type in all the commodity spot markets in the world into that cell, okay. That's how this framework should be visualized, okay. That at the intersection of asset class and instrument lie all at that intersection, you have to visualize all the possible markets that could exist. Are you following? You can play back this video and try to understand this. It's important to understand this framework. It will help you because it will help you to make sense of all the different markets and instruments that exist in the world. Otherwise it gets very confusing, okay. So the framework will help you to make sense of it. Is everyone convinced? Are you able to follow at least what we're trying to say here? This is how you have to visualize it. Think of this as at the intersection of markets and instruments. You have a massive cell which includes all the possible markets in that. And remember how we've defined markets? Gold again is a market for exchanging gold against US dollars. Coal will be, the coal market is where you exchange coal against US dollars. Okay? Against steel against US dollars or whatever. Sometimes coal and steel are not so global. So you can have local markets also. Okay? So, but whatever the local market is, in that case it's against the local currency. But we can think of them as global markets. So when I say markets here, we have 3 markets. As an example, okay, I've only been able to write 3 markets because of space limitations. Okay, so we have 3 markets here where the base asset in the first one is gold and US dollars, second one is coal and US dollars, and the third one is steel and US dollars. Each of them becomes a market because it's a venue for exchanging these 2 assets. So you see how we remain true to our original definitions. Okay, so you'll find that these definitions never change anywhere. So the whole framework is consistent throughout. Okay. Are you following? So this is what we mean by markets. And markets you've already covered, a venue for exchanging 2 assets. Okay. So this is what we mean by asset classes, markets and instruments. Okay, why this framework is called that. So similarly, if I go into the spot currency market, okay, 24/5, it trades from Wellington to New York, 24/5. You see all these currencies. So think of this box. In this box, you put in all the possible combinations. You can see only few here. You can see this one, this one, this one, this one here. Then you have this, all put in all of those currencies, and even this doesn't include everything. Okay, I think we stop. You can see all the possible combinations. Can you see them? Sterling yen, Swiss yen, Canada yen, Aussie CAD, Kiwi dollar, Singapore dollar, Euro yen, Euro sterling. Okay, all these dollar Canada, dollar Swiss, Euro sterling here again. So I take all these currency combinations and many more which are not shown here. And I take each of them and I put a comma and I keep on writing Euro USD, comma, USD CHF, comma, this, into this small box here. Okay. And if I write down all the possible combinations, okay, that shows you all these n number of currency markets. Are you able to follow how the framework should be used? So you have the intersection of currencies as an asset class, and all of these are trading mainly on a spot basis. They trade on other terms also, other instruments as well, but they all trade on mainly the main global markets for currencies. As main market is on a spot basis. Okay, using spot as an instrument type. Okay, so are you following now what I mean by asset classes, markets and instruments? Okay, you have to visualize the markets because the cells obviously here are big enough for me to write all the markets. You have to visualize it. Is that clear? Okay. All right, so we have this.
What is this Japan 225?
Where is Japan? This one?
Yeah.
Okay, that's the most famous equity index in Japan. That's an index of 225 stocks. It's called the Nikkei 225. You might have seen in certain, if you are following global markets news, you'll see they will report on what the Nikkei is doing. Okay, so this is the Japanese equity index. This is like the Nifty 50 in Japan. Okay, all right, or the Sensex in Japan. All right. So everybody knows what an equity index is. Okay. An index is just, I don't think everybody knows clearly, but an index is just an average. Okay, so instead of individually looking at everybody's grades in this class, if I just take an average grade for the whole batch, because I don't have time to look at everybody's grades, I take an average grade for the whole batch. The index is the same concept. Instead of looking at all the 225 stocks in the Nikkei average, I just take an average of those 225 stocks. Okay, and average, you can, as you know from your training in maths, average can be either unweighted average or weighted average. Okay, unweighted average is essentially just a equal weighted average. Okay, and sometimes you can weight the averages through market cap and all that. Okay, so the Nikkei 225 is an unweighted average. Okay, that's just a matter of how they've been calculating it. Okay, so whereas there's another index in Japan called the Topics, which is a weighted average. It is weighted by market capitalization, so it's not equally weighted. Okay, higher market cap stocks have higher weight. in the index. Okay, so index you can calculate as you know, with any average you can calculate in multiple ways. You can have equally weighted, or you can have weighted by some other way. So similarly, so index is just an average. That's all it is. Okay, any index is just an average of all the components in there. Okay, and you have
Please weighted average.
Nifty 50 is a market cap weighted average. Okay, so Sensex, if I'm not mistaken, Sensex is an unweighted average. Okay, Sensex is I think 30 stocks. It's an unweighted average. Okay, so this is just a matter of, but the Nikkei is considered to be more important in terms of as being a market leading indicator, that more important than the topics. Okay, which is actually the weighted average. Okay. So we just learned a little bit about indices. Okay, so you can see this. So where would you put Japan 225 here, guys? Just since we are there, where would you put it? Which row? Equities. Okay, so here we would put them. Most of these are quoted on a spot basis. So we would find this is just a matter of conventional, knowing the convention. So you would put all the global equity markets, okay, including indices, would be here. Okay, so even if you're looking at stock of Toyota Motor Corporation, okay, if you look at the stock of Toyota Motor Corporation, again that will go into this box, because most of the stock markets will be trading on a spot basis, and a common stock of Toyota Motor is not a commodity, it's not a currency, it is not debt, it is equities. Okay, so that's why I've said here single stocks and indices. So it's clear. This is how you use the framework. Okay, now let's look at something else here in this framework. Where did we come to this? Okay, so remember we studied about settlement dates and transaction dates and settlement dates. Okay, so transaction dates and settlement dates, one of the ways in which that information is useful is, one more thing you have to notice about this framework. Here the settlement, you see the settlement here, maybe I should put settlement date. So what is it? Remember we discussed a situation where you could have the transaction date and the settlement date on the same day. Okay, so those transactions are known as transactions value cash, or cash transactions. Cash transaction not in the sense of cash on delivery when it comes from Amazon, no, but these are called value cash. To make it very specific, you should say transactions value cash. Okay, value cash, it's all written in your notes, but anyway you can write it down, it maybe help you to internalize stuff. So transactions where the transaction date and the settlement date are on the same day, those are called transactions value cash. Okay, so that's why we've given, because that's the nature of the contract. So the nature of the contract defines the instrument. So that's why we are calling them cash instruments. Okay, where instruments which are trading value cash. Okay, so similarly here, so what I've tried to show, how are you supposed to read this? This particular row is referring to the settlement dates. Okay, for each type of transaction or each type of instrument. So what we are saying is settlement date for cash transactions is T+0, where T, you can read this, the T is the transaction date. So T+0 means the same as the transaction date. So this is what is meant by the statement that a transaction done for value cash is one in which the transaction date and the settlement date are the same. Okay, so spot typically, so one of the ways in which we are distinguishing between these instruments, there are other ways to distinguish. One of the ways in which we are distinguishing is that the typical settlement dates will differ from for each of these instruments. So in spot, typically it is T+2, okay, sometimes it is T+3, the settlement date, okay. And for forwards and futures, although I've given just greater than T+2 or 3, okay, but usually it is much greater than spot. Usually forwards and futures, especially for forwards, it can be much greater than so also for futures. So it is much greater than T+2 or 3. That's why I've said greater. Are you able to follow this notation?
Yes, sir.
So what I mean to say here is that the settlement date for futures and forwards is much greater than T+2 or 3, so which is greater than spot. So it will be further out than spot. Okay. All right. So similarly, these are given as just greater than T+0, but technically, but usually they are much longer, much further out. Okay. So people are getting restless. So maybe we should check the time. Oh, it's only we have 5 minutes left.
And we have viewers to.
Yes?
Viewers to.
One minute. Let's say, one sec, guys. Let's try and understand stuff. Okay, let's try and complete material. Okay. All right. So, are you able to follow this framework? So, here what I've tried to do is give you an idea as to how to use this framework. So, when you come across an instrument like a let's say a swaption. Okay, if you read that book, Risk Management Solutions, which I showed you, you'll find a reference to swaptions. What are swaptions? Swaptions are options on swaps. Okay, so essentially these are options related to. That's why I said swaps can also be. Normally, we have not listed swaps as a underlying market, but in certain types of instruments, they can be. These can also be underlying markets. Okay, so maybe I should put a slightly lower, lighter shade of this in over here. But anyway, so swaptions are options on swaps. So you would put them and swaps relate to debt instruments. So this would go into this particular box at the intersection of options and debt. Okay, so this is how you're supposed to read this framework. All right, so you can study this framework a little bit more on your own. You should, to get an understanding of this situation of global markets. Okay, so we can see the differences between various. This is all I've already discussed. This you can just read this. This is some more material over here. Okay. Okay. So just one point I'll discuss with you guys before we get into this, and so this is one thing that you have to understand, which is all this stuff we already discussed. Okay, there's some material on individual instruments. You can look at that on your own and study it on your own. Okay, but we've already discussed broadly we've discussed the instruments. You can read up on this material and see if there's anything that you want to highlight later on. Okay, so one thing we want to study is this concept of settlement risk before we go into this element. Settlement risk. Okay, what do we mean by settlement risk? Settlement risk is that suppose this guy delivers I will giving you the example of the furniture transaction. Okay, now suppose I've arranged with this guy to deliver the furniture to my living room, and I will pay him some money. So suppose he sends his delivery guys and they deliver the material. Okay, so once the material is in my house, it's like under my control. So what if I tell him that, okay, I'm not going to pay you the money? Okay, so that is an example of what we call settlement risk. Settlement risk essentially is the risk that your counterparty, in this case I am the furniture seller's counterparty and the furniture seller is my counterparty in the transaction. Okay, so the concept of settlement risk is the risk that your counterparty is not going to fulfill his contractual obligation to deliver the asset that he's supposed to deliver. Remember, you're delivering one asset and he's delivering one asset, because you're selling something and he's also selling something and you're buying that. Okay, so essentially settlement risk is the risk that one party will not perform their contractual obligations and not deliver the asset as agreed. Okay, so this can be a very significant risk, as I've given you here. Okay, is a case where there's a German bank called Herstatt which went. So in the case of currency transactions, remember, if we are doing currency transactions, what is happening is that you have one currency is being exchanged for the other. Okay, so you had a German bank called Herstatt which had many currency transactions maturing on a particular day. Okay, and on that day in the early morning of that day, that bank opened in Germany and the regulators declared it bankrupt. Okay, so if it's bankrupt, that means it doesn't have to fulfill its obligations. Okay, so whatever settlement instructions that particular bank was supposed to send out that day, okay, all that didn't go out. Okay, so whatever monies they were supposed to pay to people on that day, that money never got paid. But those counterparties of Herstatt Bank, they had already taken care, like people in New Zealand and all, because they close early. Okay, so if they had, so before closing, they would have sent their instructions to the New York office to pay dollars to Herstatt Bank. But Herstatt Bank maybe has to pay Canadian dollars to these New Zealand bankers. Okay, but they would not have given their corresponding instruction. So it's like I release the payment from my side, assuming that you will also release the payment from your side at the same, a little bit later. But you don't release the payment. But by then my payment is already gone, so I can't take it back. Okay, so what happened is a lot of other banking counterparties of Herstatt Bank who had already made their payments for that day, they were all caught by surprise, and their payments went out. And once it goes out, what happens in a bankruptcy is the liquidator hangs on to it. If I'm the liquidator of Herstatt Bank, I'll say, okay, you paid the money, too bad. This is now my money. I'm not giving it out. Okay. So then you have to like sue the liquidator and all that. So it's quite complicated. So essentially, this is the problem. So this is why we have to worry in international markets when we trade. We have to worry about this concept of settlement risk. So you have to worry about this risk that the other guy may not pay up. Okay. So this is something to be aware of. So you should understand this concept. This concept of settlement risk. It basically means that the other guy may not pay up. Okay, so we will continue this discussion. Now we are almost ready to go into why did we have to have this discussion about the asset classes, markets, and why did we have to discuss this framework? Because when we go to decision problems, the first three decision problems relate to asset class, market, and instruments. And your fourth decision problem, buy or sell, that's where valuation comes in. Okay, so we will discuss valuation, so please don't get scared. Those who are deciding to leave finance because of the fear of project finance and valuation, please hold off for one more day. But our next class is not till next week. Okay, so anyway, don't get scared.